Good afternoon, everyone. I am CA Nidhi Agrawal, presently serving as the Vice Chairperson of Gwalior branch of CIRC of ICI and presently playing a role as a moderator in this webinar. We are delighted to welcome you all to this webinar, which is being organized by the CPE Committee of ICAI. Please block your calendar for CPA webinars on Wednesday and Fridays. It is my pleasure to be the moderator for the webinar on sustainable environment and business responsibility and enhancing audit quality through NAFRA insights. In a short while, we'll start this webinar. First, I would like to apprise you about the CPE committee. In today's ever changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continuing professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars, seminars, etc. The program for this evening is as follows. We have two sessions of 1 hour each, and the topics are sustainable environment and business responsibility. Second one is enhancing audit quality through NAFRA insights. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. Please note that the medium of communication should be in English so that our participants from across the globe would be attending the program. Now, I would like to introduce our Vice Chairman, CA Vishnu Kumar Agrawal ji. CA Vishnu Kumar Agrawal ji is a Central Council member of ICA in the term 2025 to 29. He currently serves as a Vice Chairman of the CPE Committee and Direct Tax Committee of ICAI. Additionally, he is an esteemed member of several other key committees of ICAI. With over 2 decades of experience, he specializes in income tax matters and also has authored the book Landmark Judgments of Income Tax. Beyond his professional commitments, Sir is actively involved in social service and community initiatives. His professional acumen, leadership roles, and dedication to both the profession and society make him a respected figure in the accounting and taxation domain. Now, I would like to invite C. Vishnu Agrawal sir for his welcome address.
Thank you, Madam Nidhi Agrawal ji. Honorable Chairman of the CP Committee and my elder brother Satish Gupta ji. Today's session speaker CA Payal Jain ji, Sanjeev Shah ji. Sanjeev Shah ji is from Baroda and Payal Jain from Bhilai, and our moderator of this session Nidhi Agrawal ji from Gwalior. So almost from across the country, we are here to serve the particular session today. Friends, I welcome all of you in the today's session. Today is the most important session for both of the subject. Madam will speak on the sustainable environment and business responsibility, and Sanjeev Saji will speak on enhancing audit quality through NAFRA insight. Both subjects are the important topic in the today's environment, because when we do the audit of the listed companies, we always afraid that what whether our presentation is up to mark, whether any no problem will coming from the NAFRA side or not. So we medium SME medium size practitioner, we always afraid when we are doing the listed company audits. But today I'm sure my brother Sanjeev Saji will crystal clear about all the aspect of the listed companies with the regulators of the NAFRA. Friends, apart from this, we are doing several work at the ICI level. Every Wednesday and Friday, we are doing one webinar from CP committee for enhancing our knowledge and top of the top speaker from across the country we are inviting in this particular webinar. Friends, again we are working for the real time CP hours, so our chairman will apprise for that what is the real time CP hours. Friends, I am also vice chairman of the direct tax committee. Under the direct tax committee, again we are doing one webinar for only the direct tax topic on every Thursday afternoon. So I request each one of you, please attend this webinar for best of our knowledge. Apart from this, friends, again we are representing before the CBDT and Finance Ministry various representation for the betterment of our profession. Whatever practical difficulties we are facing, again we are representing before the CBDT, and we are also coming out with the revised guidance note of Section 44 AB in the after in the couple of the days, and also we are making the checklist for the ITR, how to fill up ITR, because lot of changes in the ITR is coming in this particular year. Friends, now I will not take much of the time because our chairman Satish Gupta ji is also here, and I request each one of you I that take the maximum benefit of the webinars which we are doing under the various committee. Thank you, friends.
Thank you so much, sir. Now, I would like to introduce our chairman, C.A. Satish Gupta, sir, of the CPE committee. C.A. Satish Gupta, sir, is presently serving as the chairman of the Continuing Professional Education Committee of the ICAI. In addition to this role, he is also a chairman of Udin Directorate and vice chairman of Committee for Members in Practice for the current term. He previously served as a council member of ICAI from 2019 to 2022, in which he has held the position as a chairman of CSR committee, vice chairman of direct tax committee, vice chairman of PDC, vice chairman of committee on management accounting. A distinguished figure in the professional community, CA Satish Gupta sir has also served as a president of Rajasthan Tax Consultant Association. In the past, he held the position as a chairman of Central India Regional CIRC of ICI Jaipur branch. Sir has also the recipient of several prestigious accolades, including Best Member of the Year 2004 by Rajasthan Tax Consultant, and another one is Yuva Pratibha Samman. So, with this, Sir has also the expertise in income tax assessment and reassessment, surveys and searches under the Income Tax Act, and soft skills and personal development. With a deep commitment to knowledge and professional development, Sir continues to inspire and empower the professionals across the country. Now, I would like to invite C. Satish Gupta sir for his welcome address. Over to you, sir.
Thank you, Nidhi. Thanks a lot. My brother in the council, vice chairman of the committee, Vishnu Agrawal ji from Mumbai. And I would like to tell you something about Vishnu Bhai. He is expert of searches under Income Tax Act, and he has written several books. And one book, Landmark Judgments on the Income Tax Act, is a Bible for all of us who are in the tax practice or who are in the searches practice of searches under Income Tax Act. So he is an inspiration for me or for the CP committee to work more and more this year. So, and it is privilege also that he has always given his full-hearted support day and night to the committee. And we have with us Sanjeev Shahji, eminent speaker, who will take NAFRA along with the audit quality, which are, I think, the burning topics for the members who are doing the audits of listed companies and some other companies who are coming under the age of the NAFRA. We have with us from my city of Bhilai, city of Steel, I think, Payal Jain ji, who would definitely take the topic of sustainability, which I think is the future of the profession and future of the country or future of the world. Without sustainability, we cannot think of image of any life. I think she will definitely deliver the way that we can know the opportunities for the profession in that sustainability field also. We have with us Nidhi Agrawal ji from Gwalior. She is the vice chairman of the Gwalior branch, and when I met her first time, when I see her speaking there on the dais, I thought that she should come in our webinar and should address.
Thank you so much, sir.
And she's a wonderful speaker also. And I would request Ajit Bhai that talk her and whatever topic she chooses, we should invite her to speak. And we have Ajit Tiwari ji, Secretary CP Committee, working very proactively, and we are touching upon newer heights in the CP Committee this year. We have Team CP with us, we have technical team with us, and we have our own beloved members in this webinar who are attending such a large number. So welcome to each one of you, and I'm really thankful to each one of you for giving your valuable time. Not only this in this webinar, but in all the webinars organized by the CPE committee. Friends, this year CPE committee has two targets. Number one is availability of the programs, and number two is the quality of the program. As rightly stated by the Vishnu Agarwal ji, to maintain the quality of programs, we are working to bring newer chapters, newer initiatives, rather train the trainer program. And one important thing which we are going to bring this year onwards, that we are going to allow CP credit only on real-time attendance basis. Meaning thereby, if a member register for 12-hour program, but attends only 4 hours, so he or she will get the credit of only 4 hours. So this we are going to make implementation with the help of technology, and all things are finalized. Portal working is on, and we think that the portal will be complete by 30th September maximum, and from 1st of October we would be in position to implement this wonderful initiative of the CPE committee, which I think personally and which our committee thinks it will go in the right direction for all the professionals and for the profession itself. Friends, just try to understand that we are in the 20th year of the CP credit regime. In India, 18 years of age is allowed for the voting, and you can choose the Prime Minister, you can choose your MP, you can choose your MLA at the age of 18 years. So I feel that after the maturity of 20 years in the CP, you can now welcome the step of real-time attendance in the CP program. So I would seek your suggestions, and we would definitely love to have your suggestions and feedback on this initiative. Apart from this, friends, we have provided a calendar of programs with some instances of CP credit of 100 hours, 150 hours, 200 hours to all the branches, to all the CP chapters, to all the CP circles, just to tell them that don't hesitate in selecting the topic which you want to give to your members. We have selected more than, I think, 1,000 topics, Ajit Bhai?
Yes, sir. More than 1,000, sir, segregated in various, like suggested.
Various fields, various subjects. Right. I think branches and the chapters will be benefited by that calendar, and we need your feedback on that particular item. To ensure the availability, friends, we are just opening as many chapters, circles, and groups, CP groups. And I request you that if you belong to any place where there is no chapter, there is no circle, or there is no group, and the eligibility is fulfilled, kindly let the CP committee know about your entitlement. They will tell you the process, complete the process, and I assure you that within a time of maximum by 30 days, you will get your CP chapter or circle, or that group shall be approved by the committee. So come forward, because CP is I think the brief of the profession, and we cannot tolerate that this is the most important topic which should not be compromised at all. So apart from this, friends, I would speak something about the Udin, something about the CMP, something about the non-corporate entity. I think all are facing some issues because non-corporate entity format and guidelines, although several things are not new, several things are applicable on our profession since long. But since it has come in a particular format this year only, so we are thinking that these new things have been brought for our members. No, it is not true. You go in that detail, friend, you will find that several things, several requirements of the accounting standards, several requirements of the standards on auditing are applicable since long. But we were not taking care of those all applicabilities. Now I request you, take it very seriously. Nothing is going to happen. It is going to remain. So just check that if the client does not come with new formats, if the client does not come without with following the accounting standards, so how to deal, how to frame up the accounting policies, how to frame up the notes on the accounts. You should educate your client to, because it is the duty of your client to make the financial statements, to follow the accounting standards, to frame the accounting policies and the notes. But as an auditor, you are to take care of the standards on auditing. And I think, sir, Sanjeev sir will take some of the time on the non-corporate entity part also, sir. Although your topic is larger and your topic is applicable for the NAFRA related entity, but if you are the expert of the auditing, I told by the Vishnu Bhai to me, so kindly brief something about that non-corporate entity new format and the new that guidance note, that how our members can cope up with the issues which they are facing. Friends, you must have been noting one information on the social media from last 2 days, that UDIN has brought these two changes now, that no member would be in position to get the generation of UDIN for 61st tax audit, meaning thereby if a member has more than 60 audits, since quota of tax audit is only 60 for a member, so now we have regulated this particular task through the help of UDIN, managing that and implementing that now onwards. After it will take 1 or 2 months. Now onward, no member would be in position to generate 61st UDIN on the in tax audits. So this is something I think you must welcome. It will create a huge opportunity for younger chartered accountants, and it will not compromise the quality of audit also. Second thing, friends, which in UDIN which we have brought, council has approved that also, that we are facing some time that the auditee comes to us, get accounts audited, and moves on to another auditor in the next year without paying our fees. And as in tax audit, at least we are not in position to know the name of succeeding auditor. So what we are making enable to our members, that if they want to know the name of succeeding auditor in case of their audit, because of any technical reason or because of non-payment of fees by the auditee, so now UDIN will help you. UDIN will enable you to know the name of the succeeding auditor, and after knowing the name, you can talk to the succeeding auditor. You can talk and you can communicate with him, and you can lodge the complaint even against him if he has not communicated with you as a succeeding auditor. So these are the things which our members are feeling that we should be in position to the name of the succeeding auditor. So UDIN has been enabled for this particular information. Friends, one another committee where I am vice chairman, as rightly told by the Nidhi, as committee for members in practice. And friends, I would like to say that we are coming up with several initiatives for our members in practice, members in industry, and all the members. And you will love all those initiatives. That initiative covers the term life insurance. That initiative covers the health insurance. That covers the some new credit card, some unsecured loans without collateral, some new personal accident policy, and opening of the current account and the saving account. We are coming up with several initiatives benefiting our members. I think within a month we will launch several such initiatives, which will, I believe that you would love all of them. And friends, in CMP, we have brought one course. Recently, it has been launched. That is the course on the GST litigation. It is 6-day course, and 6 day, 30 hours credit is there, but 36 hours course. And friends, it has been built in such a nice way, covering all the aspect of the GST litigation. If it comes to your town, if it comes to nearby your town, I would request that please attend this course. Although fees, you may feel that fees is slight high, but the quality of the course and the curriculum of the course and faculties of the course, a course are such has been framed in such a way that you will be benefited several times than the fees paid by you. So please ensure that you attend this course on the GST litigation. I would also talk that it is the tax season of tax audit is going to be started, and please don't have a wrong feeling that the date will be extended. It may be extended, but don't be come in the trap of that particular euphoria. Plan the tax audit because formats have been changed, and strictness regarding the implementation of AS and SAS is more this time. So take the call of auditing all the tax audits or all the non-corporate entity as soon as possible. Change the formats, bring the previous year figures in the new formats, and make the policies along with the client, sitting with the client, make the notes on try to start the audit and go for this, because I think it is our forte for some of the members, and so we should be very serious as far as tax audits are concerned. So I don't want to take much of your time, friend, because I know that the speakers are there. Sanjeev Bhai is there, Payal Madam is there, and they are going to tell you newer opportunities about the profession. They will open your eyes, because I know when Sanjeev sir will speak, you will come to know that what NAFRA can do, what NAFRA has done, and what precautions we should have to come, not to come in the clutches of the NAFRA. So thank you very much, friend. Thanks a lot for giving me this opportunity, and never forget to remember Wednesday and Friday 4 to 6 p.m. when CP committee organizes various webinars for you, covering not only GST, not only tax, not only audit, not only sustainability, but we are providing you the opportunity in the foreign countries. We are providing you the industry specific speakers telling about the opportunities in their particular industry. So be aware and be a part of this, but all initiatives of CP committee. Thank you very much. Thanks a lot. Or see you again on Friday. All the best. Thanks a lot.
Thank you so
Over
much, sir.
to Nidhi.
Yeah, thank you so much, sir. Now, there are 501 participants who are attending the event. Now, I would like to introduce our first speaker, CA Payal Jain. She has around 18 years of post qualification experience, and she is a head partner at the leading CA firm in Bhilai and into the area of sustainability and BRSR reporting, GST advisory, and strategic audits across sectors. She is a personality coach for corporates as well. She has a unique dual perspective, having led both in corporate as a senior manager, MIS at Idea Cellular, and in practice, where she spearheads regulatory reporting and audit assignments for Maharatna PSUs, cooperative institutions, and private enterprises. She is also a certified peer reviewer, GST certified holder, sustainability and BSRR certificate holder, and many more such post qualification courses of ICAI, and a passionate mentor. So, I would like to invite CA Payal Jain ma'am for his deliberation.
Thank you, CNADG. Thanks for your very nice introduction for me. Initially, I would like to thank CP Committee, ICAI, CP, our very own chairman and vice chairman of CPE, for giving me this opportunity, and also the ICAI officials who had been, working hard behind this webinar. I'll just share my presentation and then we'll go ahead with it without wasting any time. So, my topic today is sustainable environment and business responsibility. I am a chartered accountant with around 2 decades of experience in this noble profession of wealth. So, we as chartered accountants are known for our financial integrity, but gradually this influence is expanding. Now, we are at the intersection of not only financials, but business ethics, regulatory compliances, the sustainability. We are expected to know anything and everything. And I just hope that with this session, we shall explore that we as financial professionals can also be the catalyst for the change in the rapidly growing world. So let's dive into this environment, sustainable environment, and how business responsibilities are expected to be taken up. I'll just take you through the roadmap that we would be following today. We'll start with very basic what sustainable environment is, what is ESG, what is this all buzz in the corporate world? Is it important only for the listed companies or for others also? Then gradually we'll go towards the business responsibility, the role of chartered accountants we play, the regulatory framework, the landscapes, the GRIs, the global sustainability standards, then the opportunities also for we chartered accountants, how we have to make ourselves equipped. This is all we shall try to finish up in the limited time that we have. So let us discuss this. What is sustainable environment? What is all this, talking about that everywhere we go, we hear about what is sustainable environment, what is business, what is ESG, what are governance factors. So let me tell you, sustainability today is not just a corporate slogan. It is the answer to the rising climatic events, the disappearing ecosystems, and the widening social inequalities. And we, as chartered accountants, are uniquely placed into this era. Reason being, we have those three T's. The T, we have the tools, we have the training, and we have the trust to ensure that financial and non financial performance of any entity are aligned together and they are behaving transparently. So, whether it is reporting ESG metrics or advising clients about the risk, the materiality, everything, our role is very pivotal. So, what is sustainable environment? Believe me, it is not only environmental factors that comprises of sustainable environments. It is just one third part. Environment is just the one third part of sustainable environment. We'll look into that. Basically, in a layman language, sustainable environment means meeting today's needs without compromising the future generation needs that they would that would arise in future. So, in a very crude language, I would like to explain that sustainable environment implies that you use your resources in present in such a way that you keep it for your future generations. As you say, ek ped lagao, so that even your future generations do not compromise to or struggle for getting in oxygen. This is the same way. Now, as I was saying, that sustainable environment is not only about environment, it is about ESG, that is commonly known. It is about ESG. So, ESG implies environmental, social, and governance areas. These are the three pillars of sustainable environment. Let us look into that. Environmental factors implies how the working of the any business entity impacts the planet. It may include water conservation or carbon emissions or carbon footprints or managing waste. how your entity is harming the environment, or vice versa, how your entity is protecting your environment. Now, environment also includes not only your planet, but it also includes the area around you and everything. We shall look into it in detail in further slides. Then the second factor is social factors. So social factors focuses on people, be it the stakeholders, your employees, the community you are into, the customers, everything. It thinks about, the employee well-being, the community development, the fair wages, how your customers are getting benefited, or how the community as a whole is getting benefited with the business that you are undergoing into. And then, yes, of course, we have the governance factor, wherein we look into how your business is running. Is it transparent? Is it ethical? Is it accountable? Then again, the various regulatory compliances, is it working about that also? So this entire thing, entire three pillars together comprises of sustainable environment. So here the triple bottom line is about businesses should not or do not focus only on profit, but rather the balance between people, planet, profit, and purpose. Your business should earn profit, but yes, of course, with the purpose. And here we chartered accountants play a pivotal role. We have to review and advise every organization that your profit should have a purpose. It should have a purpose to grow your planet, to not to harm your planet, to not to harm the people, the stakeholders that have in your business. So, what is actually the business responsibility that goes with sustainable environment? Business responsibility. See, normally what happens is whenever I say that there is business should have a good sustainable environment and it should work towards this responsibility. So what normally people say, okay, this is about CSR, right? And CSR is applicable only to certain companies. Now here I would like to bring a red flag. It is not only CSR. Business responsibility includes CSR, but it is not only CSR. There are lot many things that a business should have to create a sustainable environment. It means contributing towards the society positively. Business responsibility goes beyond profits and also beyond shareholders. It is operating ethically, contributing to the economy, working for the environment, working for the people, working for human rights, minimizing harm to the environment, etc., etc., etc. CSR is just a very negligible part of a business responsibility towards creating a sustainable environment. Now, business responsibility is about embedding ethical practices, compliance, and sustainable into the core business practices. As I already said, it is ethical governance, the regulatory compliances, the transparent operations, the stakeholder cares, and environmental protection, which creates a brand value. And this total says that you are running a responsible business, you are creating a sustainable environment. And let me tell you, when you have such a sustainable environment, they say that this is all on papers. No, it's not on papers. Ultimately, your businesses grow when you have such an environment in your entity. You build trust not only with your employees, you also build trust with your customers. Customers today are very conscious about how the products that they are purchasing, how harmful it is for the environment or for themselves, how the company is running, We do have some certain case studies wherein we'll be talking about where the businesses have been destroyed because they are not following the sustainable environment. So such businesses which are responsible creates trust, they stay resilient and often outperform with their profits. So business responsibility is a core expectation and it is not an option. Now tell me suddenly why all this sustainability, why all this ESG, why everything? Because the planet has been there for years together. What years together? It has been there for ages together. The businesses are also going on with ages together. So why suddenly this all talking about? Why is it something marketing strength, or is it just the corporate buzz? No, it is not. This is happening suddenly. It is not happening suddenly. It is India or our country which is gradually growing towards sustainable environment. Otherwise the world has been speaking about since years together, rather decades together. This is happening because we are in the middle of climatic crisis. So many disasters are happening, so many natural disasters are happening. Also, we have a regulatory pressure. The consumers are becoming conscious, the investors are becoming conscious about the kind of environment you are creating in your corporates or you are creating in your businesses. Therefore, this all is mattering now. Now tell me, how does natural disasters affect your entities working? See, if there is a flood in Assam and you are a tea leaf manufacturer, so obviously your supply chain is disrupted because there is some natural disaster in Assam. You are seated in Maharashtra somewhere and you are a manufacturer of tea leaf and you need the raw material, but that is delayed, say by 15 days or 20 days, and ultimately your manufacturing is delayed and suddenly the consumption is delayed. So ultimately it is the profit that is hampered. So these natural disasters which are growing due to the harm that we are creating to our environment are definitely affecting your supply chain. The alarming statistics that we have for rising global environment temperatures, frequency of natural disasters that are happening, or the ESG, the businesses risk that are happening is really, really dangerous for your business entity. And therefore, creating a sustainable environment, as it says, every bit matters. So that way, the resource scarcity and so many things are happening because of these natural disasters. And therefore, it is important to create a sustainable environment. The second thing that we have is these days the investors. We have a very good example of institutional investor like Blackjack who prefer investing in only such entities which are ESG compliant or which are at least ESG aligned towards their business. So if you need good funds or good investments from a good institutional investor, then you need to be ESG compliant. ESG focused funds are also growing at a very rapid speed. So again, the investors are preferring a sustainable environmental business responsibility in your entity. Then, of course, we have regulatory pressures. SEBI has mandated the first 1,000 listed companies to be ESG compliant. They have to put up their reports in BRSR formats, which is also again very important, and you have to comply with. And do not, be here that it is only for the 1,000 listed companies. This started with 100 companies. Gradually, it grew to 500 companies. Then it came to 1,000 companies, and now the regulators are planning to bring it for the supply chains for SMEs. Gradually, I guess it would be applicable for any and every corporate entity or for any business to be compliant. They have also started with BRSR light framework, so that people get accustomed to these framework reporting. So, of course, regulatory pressures are also creating this being important. The consumers, I said, are really conscious. The Gen Zs or the millennials now look at their products while purchasing it, of obviously either the retailers or even the wholesalers, the traders. Everyone prefers products which are actually ESG compliant. Then the ESG investing growth is also, as I said, ESG funds, investing funds are also growing like anything. So because of so many reasons, now the sustainable environment is come in a limelight. Now here we have the role of chartered accountants, how we are important over here, or rather why we are important over here. We are important because we are already, we know the company in and out with their financials, but also we know them in and out with their non-financials. Only thing is we have never, put a stress on it. But while you are auditing, say for example, you are auditing a manufacturing client, you also look into their operations, you also look into their HRs. Only the data is, clustered. It is not clustered. It is haphazardly spread. So because of that, and since we are not reporting the non-financials, it never gets that importance. But now that if you go into integrated reporting, so we play an important role, right from ESG reporting or giving sustainability assurance advisories and ethical governance. We play a very important role because we act as a bridge between the non-financial and financials of an entity. We also form a bridge in various departments of an entity, like the HR, the marketings, the financials, the sales department. We can knit thread between all the departments together. So here we play a very important role. We have those compliance and governance genes into us. We are very good advisories for the compliances that are to be done for any entity, and therefore we can adapt very easily for the BRSR reportings, for the CSR rules, or for the ESG laws. We can shape internal controls of any entity to be ESG ready, to be ESG ready with all the dimensions. Then we are equipped to do the ESG audits, because every entity need a third party confirmation, and we are very well equipped, as I told, because we already know everything about the entity. We know how it is operating, how it is manufacturing, the various processes that it is going through, the various laws that are applicable to that entity, and therefore we are also equipped. Only you have to put it into the paper, you have to put it into a single format, and therefore we are equipped to do the ESG audits also. We can also be the risk advisories. As a chartered accountant, we know where our client or where an entity may face some material or immaterial risk, and we can advise them on that. We can also assess for them about the climatic risk or the operational risk that may come up because of not being having a sustainable environment in the entity. So therefore, we can be a good risk advisories also. And as I said, we can start with applicable or not applicable. For every entity, we can start with the integrated reporting, so that they are prepared for even the operational risk or the mitigated material risks that may come in future. So with the financials, we can just put a single note or something like that in the notes to accounts about the non-financials also, so that gradually the client is aware about the non-financials risk also happening in their entities. So actually, we chartered accountants are bridging a gap between the numbers and the values. Coming to the regulatory framework in India, as I already spoke before, that SEBI has made it mandatory for the top 1,000 companies to report their non-financials into a BRSR reporting framework. CSR provisions are also applicable to most of the companies who have their thresholds created for them. Then the 9 principles of national guidelines on responsible business conduct, it is base for the BRSR reporting, and gradually it seems that even MCA is going to make it compulsory to follow these 9 principles. So, understanding these regulatory frameworks is very important if you want to look yourself in this professional opportunity of sustainable environment. Let's look into this. So, BRSR stands for Business Responsibility and Sustainability Report, and it is compulsory for first 1000 top 1000 companies by SEBI, and this has started from financial year 22-23. It comprises of general disclosures, management and process disclosures, and principle wise performance of every entity. It is the 9 principles of NGRBC is actually the foundation for BRSR reporting. It covers ethics, the employee well-being, the sustainability of resources, and inclusive development of the entire community. You can just Google BRSR reporting format, and you can find it over there. It's a very simple format considering our chartered accountants intelligence. It is very simple format, and it just collate the entire data that is already present in the entity, and we just have to report it. So it is a very good format, and you can just going through it, you'll understand how the government want you to report the non-financials, the ethical, the accountability, the transparency of every entity. Then, as I said, that it is compulsory for the top 1,000 companies, but gradually the government is also putting this for smaller companies or unlisted companies also. There is a simplified BRSR light format which the unlisted companies or the other entities can follow off to be prepared for the future. It is also a buzz that by 2026, the supply chains would be mandatory. The supply chains implies all the suppliers to these top 1,000 companies. It would be mandatory for these supply chains also to report in BRSR formatting. And unless these supply chains are ESG compliant or BRSR compliant, the top 1,000 companies will not be allowed to deal with these supply chains. So therefore, again, it's a very good professional opportunity. Your client may be a very MSME entity, but it may be providing, it may be supplying to a very big listed company, which is amongst these 1,000 companies. And therefore, then even sitting in a small town wherein only internet works, but it would be mandatory for them to have the BRSR reporting, and then here we as a chartered accountants can help them to prepare the BRSR reporting and let them submit it to the 1,000 companies that are listed, and it would be a good professional opportunity for all of us. Coming to CSR mandate, according to section 135, every company which crosses a threshold, these threshold includes the net worth that is more than 500 crores, or the turnover that is more than 1,000 crores, or the net profit that is more than 5 crores. So if your company comprises of any of these three thresholds, you have to expend 2% of net average profit of last 3 years into CSR. There is a list in Schedule 9 wherein 9 categories are mentioned wherein your CSR can be expended. It is recommendatory. It is not compulsory that you go into these 9 categories also. You can go beyond it also. But where here the mandatory thing is made to ensure that such companies, expend their profit something for the society, giving back to the society. Therefore, such mandates are made up. Coming to NGRBC, NGRBC has stands for National Guidelines on Responsible Business Conduct. There are 9 core principles. You can just Google them. It is very easily available on the website, the 9 principles. And these form the base for this BRSR reporting. It is for promoting ethical, inclusive, and sustainable business practices. These principles promote ethical and sustainable business practices, and it is the foundation for ESG reporting under SEBI's BRSR framework. Some of them, include providing safe and sustainable products, or ensuring employees' well-being, or engaging responsibly with stakeholders, or supporting inclusive growth. These are the principles, and they are very well explained. You can just go through them and you'll understand. So now, why chartered accountants are critical here? Because we can help companies gather and validate this ESG data. We can help them prepare disclosures, or even provide assurance services to them. This opens up a very significant new avenue in ESG related area. Coming to global sustainability standards, as I said, we are a child in this sustainable environment, but the world as a whole has been way beyond ages that they have already started working into sustainable environment for the entities. And there have been various regulatory standards also that are there for creating formats, integrating reports, and creating good environment. So again, I would like to say that since it is a globalization, it is very good that India has started this initiative through BRSR reporting, and gradually we shall be at par with the world sustainable environment. So GRI is Global Reporting Initiative, and it is most commonly used framework around the world, and it offers comprehensive guidelines across various industries, various entities, various kinds of companies. Rather, you can say, it is a common standard reporting which can be adapted by anyone and everyone. Just a contrast to it is SASB, Sustainability Accounting Standards Board, is industry specific. It is particularly customized for each specific industry. So, and then we have International Sustainability Standards Board under the IFRS Foundation. TCFD is Task Force on Climate Related Financial Disclosures. The TCFD is established by Financial Stability Board to develop a set of voluntary and consistent disclosures and recommendations for the companies to report only climate related financial risks and opportunities. There are 4 key areas that TCFD focuses on. It focuses on governance, strategy, risk management, and metrics and targets. But moreover, it rounds about the climatic risk and the climatic conditions of an entity. Then finally coming to ISSB, that is International Sustainability Standards Board, it is a big step towards global consistency. As you know, IFRS is being done for financial reporting. It is a global standards reporting for the financials. IFRS is doing the same way is ISSB. It is a global non-financial reporting, and it is how the businesses are selecting the right framework and ensure proper disclosures. ISSB has a unified global sustainability disclosure standards, which is in align with GRI, SASB, TCFD, IFRS S1 and S2. Then the next is sustainability assurance, not the financials I'm talking about here. The sustainable assurance, this is through ISAE 3000 and SAE 3410. These words, may be sounding very jargons and like very technical, but believe me, you just dig into it, you study it, and they are very easy. And definitely, it would give a good look into when you look into these words, and they are very easy to understand as well. So ISAE 3000 provides a broad outlook on assurance of non-financial reports such as sustainability or CSR data, etc., etc. While SAE 3410, it specifically talks about verifying greenhouse gases emissions. So these are the two standards which are related to the sustainable assurance. Most of the companies in the country have started working for sustainable environment. Most have already been there as the backups for sustainable environment. Like Infosys has been a very good example. It has become totally carbon neutral, and this is through various social projects that they take up, or various social responsibility programs that they take up. Then it has become Infosys has declared them as total carbon neutral. This does not mean that they are not emitting any carbon in the environment, but they are doing as much as carbon that they are emitting in the environment. To balance it, they are doing other works, like they are growing trees, or they are purchasing carbon credits. Now, what is purchasing carbon credits? Purchasing carbon credits is, there are many NGOs. For example, there are many NGOs who work on to controlling the carbon emissions that are happening in the environment. So they do have the carbon credits, and these people, they sort of sell it to such companies wherein the carbon emission is very strong. So these companies, when they purchase, in a way, they are expending on creating carbon neutral environment. So that is why this is the way it is called, carbon credit purchases. These are kind of the transactions. Talking about Tata Group, Tata Steels have put in lots of efforts to reduce their carbon emissions. The TCS is also working on so many socially responsible uh, programs. Then they have a very good employee environment in their organizations. They have so many SOPs created. Contrast to that, we all know about the Volkswagen Dieselgate scandal, wherein they had done emissions cheating, a clear ESG governance failure. So as they say that now, creating a sustainable environment is not, it is mandatory, it is not just an option. Then talking about Mahindra has become a net zero. They have a net zero target by 2040. They have declared that by 2040 they will be totally net zero. Mahindra through Mahindra Electric, they are saying about. Then they are also water positive. They are conducting a lot of water positive production operations. So as we talk about Tata Steels or we talk about the Volkswagen Dieselgate, sustainability can either drive you or it can destroy you. So it is very important that we work proactively and we assess our risks, we ensure our transparency and embed ethical practices in our entity to create a good environment, to create a ESG compliant environment, to create a sustainable environment. Coming to a very important slide of the seminar, professional opportunities for we chartered accountants. I would say instead of taking it as a professional opportunity, why not we take it as our giveaway to the society? And when we take this as our giveaway to the society, definitely it would help you heal yourself, and definitely it would help heal your environment. So how do we have sustainability is now just not a compliance issue, but it is also a career opportunity. There is a growing demand of ESG assurance services. It just similar to financial audits. Companies now need a third party confirmation that their entity is working properly, that there is no problem or there is no employee unrest in their company, or maybe the employees are happy in their company, or maybe their entity, the products that they are creating are not harming to the environment. So the companies actually want to know about it. And here we play a very important role. We can give them ESG assurance services. We can give them advisories. We can mitigate their risk. We can, पहले से उनको आप वो कर सकते हो, आगाह कर सकते हो for the risk that may happen in future for them and that may create huge losses to them. So these kind of advisories are also very much into it. The companies really want to know about all these things, and we as chartered accountants should not limit ourselves only to the financials, but we should also look into these non-financials data and just keep on talking about it, and somewhere the companies also definitely will react to it. So it is a very good opportunity. Then sustainability consulting and strategic development. Here it is again a very good opportunity, career opportunity I should say, because people, you can consult them that how they can create a good sustainable entity, how you can advise them for ways and means to create a good environment in their own, for the employees, for the stakeholders, for the customers in their entity, how this would help them grow, how this would help develop, would be a good path for the development of their company. Sustainability strategy consulting is definitely another emerging area. It helps firms identify their ESG related risks, and they can align their operations that way that their entity not only creates a sustainable environment but also gradually grows, gradually develops, and goes another level stage. Then we have green finances. Here, CAs can play a pivotal role because, again, it is somewhere related to the investments, the numbers. So we can, structure climatic bonds or manage carbon credits. We can also advise on sustainable investments, how companies, can put up and invest in sustainable environments, or how can it can pool funds from the ESG growing investment companies like Blackjack. So green financing again. Advising on green financing is again a very good opportunity that we chartered accountants can help our entities, our clients to look into it. Then for those looking to specialize in these areas, I would suggest that go for certifications. Start with the BRSR certificate course that our institute is providing. There are other certifications also, such as then IFRS sustainability, the climate finance, the CFA ESG modules are also very valuable. So just since we are not, we are not so, there is a talent gap. We are not so very accustomed. We know all these things, but we are not so very accustomed to working onto it. So these certifications would help you learning about this. And once you have the knowledge, definitely you know how to apply it. So go into it. Chartered accountants are very, very critical in this environment, and it is, since this is a very upcoming area, definitely it would create very good opportunity in it. Would help companies gather and validate their ESG data. Then you can help prepare disclosures also. You can also provide assurances. So definitely, I would say this is a very good avenue to have ESG related services. Keep on speaking about all this in with your clients or in your board meetings. If you are a employee, if you are in an industry, create budgets for sustainable environment, mandatory or not mandatory for your company, but you can start with it, because definitely in future you are going to fall into this pool. It would be mandatory for you as well, so why not start it from today only? But for creating such opportunities, you also need to have a good toolkit. As I said, the data is haphazardly present in the entire entity. It is not put up in one single department. So we have to, be the, when you go for your financial audits also, just get a heck of other departments, create that pool that data from every department, and just put some notings about it, put some notings in your financial reportings as well, and create an integrated reporting of financial and non-financials. So this is the way you can start with. You can use various dashboards or analysis or visualization tools to make your entities aware of the future upcoming risks or the ESG risks that they are already facing, but they are not aware about it. You can use systems that track carbon emissions or the employment diversity or the board independence, etc., etc. You can use all these tools to make the companies aware of the things that are not actually happening there. Then also, as I said, integrated reporting, start doing that. Start creating internal controls for your entities to mitigate ESG compliant things, to create ESG related things in already, like you can create SOPs for them to be ESG compliant, or you can create such controls that they fall into the audit ESG audit frameworks, or you can also let them apply gradually. You can advise them to get applied to BRSR light framework of ESG auditing. Then, as I said, collaborate with various departments, talk with the legal, the HR, the compliance, the strategic departments, the sales department, the marketing department, and bring all of them on one single pace, on one single table. We can also assess the material risk that are happening. We can also give them ESG risk mappings. We can integrate internal controls and SOPs into various departments, not only financial departments, but in various departments. We need small things also can be initiated. Like if you are doing a monthly audit, just one step every month, and it would maybe at the end of the year, they would be compliant totally. So it's good. Material assessment can help organizations identify and prioritize ESG issues that matter very much to the stakeholders, wherein the stakeholders always have an eye on all these things, but they never speak about it. So if the boards are already prepared or are already proactive about it, it would be good. They can also create ESG scorecards, wherein they can just create such scorecards and just keep on ticking yes, yes, yes. Okay, then done, this done. Then they can create targets for it. For every month, for every quarter, they can create such targets and just go on ticking yes, yes, yes. This done, then this done, kind of thing. There are definitely challenges and risks also in this area, like the as already discussed a lot about it, that all this data is scattered into various departments, and collating the entire data is one difficult task. People are hesitant about it. People do not want to share their data. So this is a very big difficulty that maybe people would face. But then with time, with awareness, definitely people can become like Tata Steels, wherein they are already net zero kind of thing. The regulatory framework is still evolving. It is not totally compliant, totally evolved, or totally developed. We are still dependent on the global framework. So gradually, when the global frameworks, to integrate ourselves with the global frameworks, it creates a difficulty. The framework are changing day by day, and multiple systems are involved into it. So again, that is a challenge that we have to face. Slowly and gradually, when the things are streamlined, it would help us, but in the initial areas it would be a difficulty. The As I said, there is a talent gap. We are still not totally trained to do the ESG accounting, but certifications, the courses, the knowledge pooling areas, discussions with the people definitely can make you a good trained professional, and you can definitely work with it. Then about greenwashing and ethical dilemmas definitely happen. There are certain companies like Volkswagen, Dieselgate, wherein people are claiming that they have been doing sustainable projects, but actually they are not doing. This is called greenwashing. This is also happening, where we chartered accountants has to be very vigilant about it, that yes, this may be there, and we have to look into it, and we have to catch onto this, and we have to advise our client that such non-ethical practices or such dilemmas should not be taken by any of the companies. We as chartered accountants should advise our entities not to divert with these things.
Ma'am, I'm extremely sorry. Actually, time is running out. There is another session also. So kindly conclude in a minute
I
or two,
understand, Nidhi. This is the last slide actually.
Okay, thank you so much.
So here, as I said, we have to create a toolkit. So the road ahead is you have to upskill yourself, you have to influence people, and you have to abide by the laws also. For chartered accountants, this is definitely a defining moment. Sustainability is integrated into every aspect of companies reporting, governance, and strategy. So what we have to do is we have to upskill ourselves. There are various platforms like Harvard Online, CFA's Institute, ESG certifications, our ICAI certifications. You can upskill yourself, collaborate with different departments of every entity, lead ESG dialogues, create strategic integrations, use examples of companies such as Mahindra or Tata Steel or Infosys, where sustainability is already there, and create budget. If you are in a leadership, create budget, create integrated reporting, though it is not applicable to your client, but create a integrated reporting, and make people future compliant, future ready, future prepared. I would suggest some activities and learnings, like go on IFRS Sustainability Hub, read about GRI standards, read about SEBI BRSR guidelines, and create one ESG goal. If you are in your office, if you are in an industry, start with one small step of reducing waste in your office, or encourage talks whenever you're talking with your client, whenever you are in a board meeting, talk about ESG, talk about sustainable environment, make people aware about it, and make people future prepared. To conclude, I would like to say that sustainability represents a significant risk if ignored, and a massive opportunity if it is embraced. So the tools are available with us. The need is very urgent, not only in our country but globally, and that people already trust us as a chartered accountant, as a financials professional. So why not also encash this opportunity as a non-financial report for non-financial reporting as well? Chartered accountants are no longer just scorekeepers, they are strategy enablers in a sustainable future. Let's drive this business into values that are beyond profit. I'm really thankful to CPE committee and all you viewers for being here, for listening to me. I'm sure that you are going to start with this one single step today. Thank you. Thank you so much.
Thank you so much, ma'am. Ma'am, there is one question which you have already answered, right? So, the question is, does ICA provide a certificate in sustainability reporting? So, you have already covered it in your slide.
Yeah,
So, yes.
ICAI does
Yeah.
provide one BRSR course on sustainability. You can go on the DLH hub. The batches are launched online very oftenly, and you can register into it. There are it is a 9 days course, and a very useful one to understand all these so many technical jargons that I have used today.
Yeah. Thank you so much, ma'am. I'm very thankful on the part of CPE committee for such a nice deliberation. And it would be appreciable, ma'am, for giving your crucial time in the coming webinars as well. So again, thank you. And now I would like to introduce our today's session two speaker, Honorable CA Sanjeev Shah sir from Vadodara, Gujarat. CA Sanjeev sir is a practicing chartered accountant and founder to Messrs. Shah Sanjeev and Associates, Chartered Accountants, Vadodara, Gujarat, and practicing in areas of mergers and acquisitions, forensic and whistleblower investigations, cybersecurity, internal financial and risk controls, business restructuring, and domestic international funding for more than 30 years. By qualification, Sir is a science graduate, chartered accountant, certified fraud examiner from ACFE USA, and certified cybersecurity from ISC2 USA. He was the chairman Vadodara branch of ICI in 2003. Currently, he is a co-opted member of DAB for ICI 2025 to 2026. He rendered several services as independent director with PSUs and like Container Corporation of India, Concor Air Limited, Fresh and Healthy Enterprises Limited, and also with some private sector listed and unlisted companies as well. He served Vadodara Stock Exchange as SEBI nominated public interest director and also as a arbitrator. Now, this is all about the so many huge achievements for sir. So I'm so grateful, sir, to be with you. Now there are 601 participants with us. So now over to you, sir.
Nidhi, my presentation is visible now?
No, sir, it is not right now.
No?
No.
Okay, let me.
Yes, sir. Yes.
Is it visible now?
Yes, sir.
Presentation is presentation visible?
Yes, sir.
It's visible, sir. You can go ahead.
Go
Okay.
ahead. Yeah.
However, you can just make it full screen, sir.
Yeah. Okay. Okay. I'll make it. I will make it full screen. Okay. Yeah. So good afternoon, everybody. And first of all, thanks to CP committee for giving me this opportunity for sharing my thoughts on a completely new subject and new area for the practicing chartered account. There are a lot of concerns and worries to the practicing CAs as far as various NAFRA orders and all. So brief about the NAFRA, everybody knows, of course, is an independent regulatory body, and in its inspection, investigation report, and disciplinary orders have brought to the fore not only instances of non-compliance and professional lapses, but also valuable insight into systemic deficiency in areas needing reforms. NAFRA is not a substitute, but a parallel regulator for a defined class of auditors. ICI continues to regulate all members, but NAFRA has exclusive oversight where it applies. Here, the focus is not only merely on identifying what went wrong or what were the lapses or mistakes by the auditor, but asking how we can do better. How audit firms strengthen the internal controls and quality review mechanism. How the partners and engagement teams ensure compliance with standard of auditings and SQC1 in letter and spirit. Now, let me touch upon very briefly about the applicability of NAFRA regulations. All listed companies and large unlisted private companies with paid-up capital of 500 crores or more, annual turnover of 1,000 crore or more, and aggregate outstanding loan debenture deposit of 500 crores or more are covered along with the banking, insurance, and generation of electricity companies at present. Let me tell you, NAFRA can initiate suo motu action under AQR on receipt of whistleblower complaints. That is very dangerous thing. Under section 134(2) of the Companies Act. Now, briefly on the penalties. NAFRA can impose penalties on individual CAs. The penalty between 1 lakh to 5 times of the fees received by the respective chartered accountant. And for audit firms, the fine penalty goes from minimum of 5 lakhs to 10 times of the fees received by the firm. And as far as the debarring the members are concerned, it may vary minimum from 6 months to 10 years. So this was something about the brief of NAFRA and its regulations. Now, let me start my presentation. The presentation is divided mainly into 3 parts. One is the audit, the audit failures and overview. This second part would cover the case studies, and the third part would largely cover key standards of auditing and key takeaways for chartered accountants. Now, this slide is very important to understand what are the major lapses by the auditors and audit firms as observed by NAFRA. One is failure to report material misstatements. Second is improper reliance on management representations, followed by inadequate risk assessment and planning, neglect of fraud risk as procedures. Fifth is deficient audit documentation. Sixth is no verification of recoverability and provisioning. Seventh is misuse or omission of modified opinions. Eighth, non-compliance of key standards on auditings. Ninth, related party transaction not properly audited. And last, 10th, engagement quality control review, EQCR, and standard on quality control, SQC1 failures. These are the 10 failures I am going to take up in my presentations. To start with, number 1, failure to report material misstatements. What happened if auditor identified a material misstatement which is either not corrected by the management, or if it is so significant that it affects the true and fair view of the financial statement? Now, Material misstatement is considered material if it could influence the economic decisions of the users taken based on those financial statements. The action required under standard auditing 705, it mandates a modified opinion if the misstatement is qualified, if the misstatement is material but not pervasive. Pervasive means extensive or widespread. And then opinion has to be adverse if the misstatement are both material and pervasive, and opinion can be disclaimer of opinion when sufficient evidence cannot be obtained and possible effects are material. Now, why it matters? A clean report implies financial statement present true and fair view, and if the auditor knows the numbers are inflated, manipulated, and unverifiable, but still gives a clean opinion, it becomes a false assurance to the stakeholders. It determines public trust, compromise integrity of financial reporting, which lead to financial losses and regulatory failures. Now, types of material misstatement found by NAFRA: fictitious equity infusion, share capital. For an example, share capital recorded without issuing actual share. We'll see the case study. Round tripping of funds, fund cycle through intermediaries and back to group entities to falsely inflate revenue or assets. To be followed by unsecured advances without recovery plans, large advances paid without visibility of recovery plans and without proper documentations, which indicate high risk of default and potential misappropriation of funds, and an undisclosed liability or NPS, failure to report tax demand, bad debts, or overdue loans, which understate the company's obligations and creating a false impression of financial health. This kind of omission can have a significant legal and financial consequences. Case study number 1, Z Entertainment, wherein is all these contents have been taken from the website of NAFRA. So these are all contents from the NAFRA website. The case study is Z Entertainment Limited, wherein 200 crores advances was improperly shown as advertising advance, but was actually routed to various group entities through unrelated third parties for purposes other than advertising. This misrepresented obscured the true nature of the transaction. What happened? There was no audit qualification by the auditor. Auditor failed to identify and disclose the round tripping of funds, issuing an unqualified opinion despite clear indication of financial irregularities and related party transaction. What NAFRA observed? NAFRA found that a material misstatement was ignored during the audit process, leading to clean audit opinion that did not reflect the underlying financial issues within Z Entertainment Limited. Next case study is Brightcom Limited, wherein it was observed fictitious equity infusion within the company, and the company claimed 867 crores funds raised through preferential allotment, but most of the shares were never issued, and some consideration received by book entries and journal entries. Even surprisingly, no PS3 was filed with ROC. The money was recorded as equity, artificially inflating the company net worth. And audit failures. Auditor failed to report the material misstatement regarding the fictitious equity infusion. Despite clear red flags and lack of supporting documentation, and clean audit opinion was issued by the auditor. This highlights serious lapses in due diligence and professional skepticism. It followed the regulatory scrutiny, the discovery of the fictitious equity infusion and audit failures. Regulatory bodies initiated investigation into Brightcom Group's financial practices. In case of SRS Limited and Sobha Limited, these are two known real estate players, wherein case of SRS, what were the key issues? The company provided substantial advances to group companies without ensuring recoverability. Despite heavy losses and NCLT proceeding, a clean audit opinion was issued raising concern about the audit quality. The financial impact, lack of recovery of advances contributed to the company's financial instability. In case of Sobha Limited also, the company extended 1,800 crores of advances without proper diligence on land ownership or assessing recoverability. And this significant issue was not reported as KAM, key audit matter, or qualified in the audit opinion, indicating a potential oversight by the auditor. Compliance concern: failure to verify land ownership raises questions about regulatory compliance and risk management. These are all observations from NAFRA and reported in the respective company cases. Professional misconduct: how? NAFRA has observed three professional misconduct by way of a violation of Clause 5, second schedule of CA Act, which says failure to report known material misstatement leading to financial irregularities, and Clause 7 of CA Act, negligence and lack of sufficient information gathering resulting in inadequate audit evidence and unreliable financial reporting. Now, Standard of Auditing 705 is also violated by not observing the no modification despite pervasive extensive misstatement, indicating a serious breach of auditing standards and failure to protect the shareholders. How auditors should respond to misstatement? Yeah. So when misstatements are found by the auditors, auditor first should communicate this with those charged with the governance. Now, who are TCWG? TCWG typically include board of directors and or audit committee. Auditors should determine if misstatement is material and or pervasive, considering both quantitative and qualitative factors, and evaluate the aggregate effect of uncorrected misstatements. And based on whether it is a pervasive and whether it is how to define the opinion. For isolated but material errors, it has to be qualified opinion. For misstatement affecting the overall integrity of financial statement, it has to be the adverse opinion. And if auditors are unable to obtain sufficient evidence, then it has to be a disclaimer of opinion. Now, what are the key takeaways for auditors under reporting misstatements? Evaluate materiality. The auditor has to assess if misstatements are material or pervasive, considering both quantitative and qualitative factors. And then do not issue clean opinion if material misstatements are existing, and don't hide such issues. This is very important. Don't hide such issues under key audit matter or emphasis of matter, which are no substitute for a qualified or adverse opinion. And advisory: document everything. Auditors have to maintain robust documentation of the issue, discussion with the management about the material misstatement, and this document should include the rationale behind the chosen course of action, whether to go for which kind of opinion, whether it is a qualified opinion, adverse opinion, or disclaimer. The auditor has to maintain and document the rationale behind such chosen course of action and any consultation with the management and experts. Now, the second lapse, which I listed out, is improper reliance on the management representation. What does it mean? Management representation are written or verbal statement provided by management to the auditors, and they are in fact considered the least reliable form of audit evidence due to their inherent subjectivity and potentiality for bias. Now, SA 580 and 500 emphasize the importance of obtaining sufficient appropriate audit evidence, and this requires auditor to seek independent and collaborative evidence from sources other than management, especially when the red flags exist. What went wrong on the cases observed by NAFRA over reliance on management? Auditor accepted management explanation at face value without sufficient scrutiny. They failed to challenge assumptions, and then there was no independent evidence from the external or third party, which poses significant risk of undetected misstatements. auditor also issued clean audit opinion based purely on the management supplied information. Under this irregularity, the case study under Z Entertainment Limited, which I mentioned in the earlier slide, the 200 crores were routed back to the group companies by advances to one company and again routing back to the group company. Auditor relied heavily on the management and legal opinions provided by the management without seeking independent verification. That was the mistake. That was the irregularity which NAFRA observed. And lack of scrutiny. Critical transactions were not scrutinized effectively by the auditor. And then despite all this, the auditor, despite the material misstatement, the clean audit opinion was issued. Case study number 2 by Coffee Day Enterprises CCD, where fake interest income and fabricated advances were reported, were observed, wherein auditor relied heavily on comfort letters issued by the management and they failed to challenge the authenticity of these letters or conduct impairment testing to determine the true value of the assets. Now, what were the lapses? The audit did not adequately verify loans granted to company with no apparent operations despite clear red flags suggesting potential fraud and mismanagement. Here also no impairment testing was conducted by the auditor when loans lacked security and cash flow. In case of Reliance Capital, again I am repeating, these are all reported under NAFRA website. Reliance Capital, loans to shell entities. 6,500 crores loan were disbursed to shell entities, raising various concerns, serious concern about the fund diversion. The co-auditor here, please note that here in this case, this company's case, the co-auditor resigned, explicitly raised a fraud alert, highlighting the irregularities and risk associated with these transactions. Despite that, the principal auditor sided with the management, effect identified by the co-auditor. More on this, despite clear warning signals and absence of adequate loan collateral, the principal auditor concluded that no fraud in the report. Why blind trust in the management representation is risky? Because audit loses credibility and objectivity if management representation are not challenged. Risk of fraud. Management may be tempted to cover up poor financial performance if they know the auditors will not scrutinize their actions. Here, the standards violated on irregularity on reliance on more reliance on management representation, SA 200, SA 500, SA 580, and Code of Ethics, where auditor failed to challenge client representations. How auditors should handle management representation kind of irregularity? Auditors should evaluate management claims critically and challenge their assumptions, cross-verify and seek external confirmation from customers, supplier and banks as suggested under SA 505 and ensure that it is independent and verify it addresses the exact issue and consider full facts. In some cases, NAFRA has observed that auditor has simply on a face value accepted the legal opinion provided by the management and relied heavily on this. Now, key takeaways as far as these irregularities, lapses. Management statements are not substitute for audit work. If information cannot be independently verified, auditor must qualify or disclaim audit opinion. Deeper testing is required when warning signal appear. What kind of documentation to be preserved by the auditors? The question asked to the management, alternative explanation considered by the auditor after consultation with the management, and evidence tested. All these things have to be documented and kept in the audit file. Third one is inadequate risk assessment and planning. Here, there are three applicable standards on auditing: SA 300, SA 315, and SA 330. Under audit planning, there has to be a thorough understanding of the entity before the audit starts. And then auditor has to identify the risk areas before the audit starts. And then accordingly plan the audit plan based on the risk area identified. What are the key issues observed by NAFRA? Audit plans were missing. And these plans were not based on actual entity operation, resulting in a superficial evaluation. The audit plan which were submitted to NAFRA by the respective auditors under the investigation by NAFRA, these are the observations. These plans were not based on actual entity operations, and there was no specific response or testing procedures were documented for identify risk. Man Industries and Banpur Cement, here also there was an absence of formal risk assessment procedure, and then there was a failure to develop a tailored audit response. And despite pervasive misstatement, risk responses were not documented. In case of Banpur Cement also, no documented audit strategy were found by NAFRA. Lack of documented understanding of internal controls, and the auditors ignored the key financial risks such as non-performing asset and contingent liability. Here also, SA 300, 315, 330 completely ignored by the auditors. In case of DHFL, Diwan Housing Finance Limited branch audit case, here the audit began without a formal engagement letter or planning documents. There was no team briefing. There was no risk register maintained by the company, because auditors are required to report internal financial control under section 143(3)(I) if the weakness is there, and if these weaknesses are impacting the financial conditions of the company, then the auditor have to report under section 143(3)(F) if it is going to affect adversely. NAFRA has observed that audit conducted without specific risk documentation, and auditor perform a routine check without tailoring the audit procedure. Here also related standard violated. SA 300, SA 315, 330, 320. What are the key takeaways for the auditors? Auditors have to analyze business operations and review financial statement, internal controls before the audit process starts, and accordingly devise their audit plan. Auditors have to spot vulnerabilities and unusual transactions, related parties transactions, and prior fraud history if it is available. Document and update plan. Describe responses, assign responsibility, and revise plan as needed. Update the plan as and when the new information becomes available or circumstances change during the audit. These are the key takeaways. Now, the fourth risk, neglect of fraud risk procedure, is very important nowadays because of a lot of scams and irregularity found out. The promoter diversion were found out, whistleblower complaints have been given, and SEBI has started investigation in some cases. NAFRA has also started suo motu action. ICI has also started suo motu action. So auditors' responsibility under this SA 240 is extremely important. It is mandatory responsibility to assess and respond to the risk of material misstatement due to fraud by maintaining professional skepticism. Now, what went wrong in NAFRA cases? Auditor failed to perform fraud risk procedure. Auditor ignored red flags in related party transactions, circular transactions, and fake advances. Auditor heavily relied on management representation without obtaining independent verification or third-party verification. Despite fraud indicators, no modified opinion and no communication with those charged with the government, that is board of directors or chairman audit committee or audit committee. Coffee Day and Brightcom, here also, as I mentioned, fake interest income 187 crores were booked to inflate profits. There were evergreen loans through complex related party transactions. to repay earlier loans, keeping them performing on paper. Here also auditor heavily relied on management assurances. In Brightcom also, the company claimed equity infusion of 867 crore with no shares issued. So no fraud risk assessment conducted despite red flags. This was observed and found out by NAFRA. In this case, that auditor did not conduct fraud risk assessment and also issued a clean audit opinion, even though material misstatements were existed. Z Entertainment, which I mentioned earlier, 200 crores were routed through various agencies, again coming back to the group company, the parent company. Auditor accepted legal opinion instead of conducting independent view, and no assessment how the transaction was structured to receive. Reliance Capital, 6,000 crore were advanced to sale companies and used to repay earlier loans, that is evergreening of loans. Here also I mentioned earlier, the co-auditor resigned, citing the potential fraud. Despite that, the principal auditor did not take action, issued a clean report. Here also standards violated 240, 200, 230 and Code of Ethics. Auditors avoided conflict with the client management. This is normally found in many of the cases. Fraud indicators auditors should watch for. Related party transactions, circular payments, unusual advances, journal entries, and pressure to perform to meet the financial target, especially in a listed companies. How to comply SA 240? Auditor team has to brainstorm to discuss how fraud could occur and update risk assessment if any red flag or irregularity emerges during the audit while observing creative accounting, discrepancy or malpractice. Unusual journal entries and adjusting entries, particularly near end, has to be checked thoroughly, and non-routine or one-off transaction also have to be thoroughly checked. Also, auditor have to perform unannounced stock checks and direct confirmations, and then implement surprise audit procedure like unannounced cash counts, inventory observations, or confirmation with the customers and suppliers. Here also, what are the key takeaways? Fraud risk assessment is optional, is not optional but mandatory. Investigate related party and circular transaction properly and modify audit opinion if it is needed, and report if you find out misstatement or fraud or potential fraud or possibility of fraud. Then you auditor must report those charged with the government, that is board of directors and or audit committee, and possibly to authorities under section 143(12) of the Companies Act if the fraud amounts exceeding 1 crore rupees. Now the fifth deficiency is deficient audit documentation. This is also very important because many of the cases NAFRA has observed that the auditor has not maintained proper documentation. So documentation requirements covers what was audited, what evidence was obtained, what conclusion were reached, and who did the work and when. These are very important. Auditor must ensure compliance and record planning procedures under section SA 300 and responses as SA 330. Very importantly to note that auditor have to log the file within 60 days from the audit report, that is audit file completion days, and then clearly identify who performed and reviewed the work and when to ensure accountability. Because these are important parameters under SQC1, we'll see in the last slide. What went wrong in NAFRA audits? NAFRA has observed that auditors submitted incomplete audit files with no working paper supporting their conclusion. That is the reason I mentioned that all decisions of the audit to arrive at a particular decision has to be substantiated by documents. While communicating with the management, the response received, and then alternate mechanism, alternate options which were considered by auditor, all has to be documented. Backdated, NAFRA has observed very seriously that backdated documents created after the audit report was signed. Missing documentation. Auditor maintain only template files, standardized checklist, and no engagement specific documentation. These were the lacuna found by the audit, NAFRA. Case studies, DHFL, Man Industry and Coffee Day. These are almost the same observation we discussed earlier. Only thing, in case of Man Industry, you will be surprised to know that the working papers submitted by auditor to the NAFRA included reference of GST. Though the audit area of 15-16 was pre-GST area. In case of Lexus Granato India Limited case study, the NAFRA found that the auditor maintained two files, two versions of the file, audit files. One submitted to NAFRA and another file submitted to BSE and NSE. We must understand that NAFRA is always working in tandem with other regulator as well. So if something is different with the two regulators or two investigating agencies, they will immediately come to know. Here also you will surprised to note that the EQCR reviewer denied any involvement to NAFRA, indicating that documents may have been fabricated. What are the missing working papers found by the NAFRA? Sampling plan, internal control assessment, materiality threshold documentation. These were not found, missing. What documentation failures are serious? Why? Why documentation failures are serious? Because audit documentation is a legal proof of work performed, and it serves a critical piece of evidence in legal and regulatory proceedings. If document is incomplete, it amounts to professional negligence, false reporting, and NAFRA penalize and debarred auditors for maintaining fake or insufficient documentation. Here also standards and regulation violated 230, 300, 315, 320 and SQC1, because under SQC1, of course, we'll discuss this at a great length in the later slide. What are the key takeaways as far as audit documentation? Documentation is the foundation of the audit credibility. It is essential for supporting the auditor's opinion. And quality control partners should regularly inspect files for completeness and accuracy. NAFRA's interpretation is, if there are no documentation, it amounts to the no audit performed by the auditor. Sixth, lapse. No verification of recoverability and provisioning. Now, auditor have to verify recoverability of loans, advances, security deposit, and receivables. And auditor have to assess need for provisioning and impairment if amounts are overdue for a long time. There are no legal enforceability seen for recoverability, and counterpart is facing financial problems. Say kind of somebody has taken the company into NCLT. Then it amounts to the uncertainty about the recovery of the amount. Standards to follow: provision for provisioning, since impairment testing is required, Ind AS 109, AS4, SA 500, SA 505, 540, and 700 and 705. NAFRA has found that auditor failed to test recoverability as far as recoverable advances and impairment testing. Auditor failed to test recoverability, accepted management assertion, and ignored impairment requirements. They also observed that auditor relying solely on management representation without independent verification and issued clean audit opinions without any qualification. These failures cause material misstatements. Soba Limited and Brightco Limited, again the same cases. A lot of unsecured loans without, in case of a real estate player, they give advances to get some land and other things. Here it was found that 1800 crores were found where advances were given, but there were no title and no confirmation from the third party, and the company did not go for any provisioning. Despite that, auditor issued a clean opinion. What auditor should have done? Thoroughly examine all relevant legal documentation pertaining to advances and loans. Obtain confirmation, seek external confirmation. An auditor has to review aging schedules to determine the length of time receivables. Length of time receivables and advances have been outstanding. Auditor has to assess the likelihood of recovery and then recommend impairment provision with disclosure in audit report as per SA 700 and 705. Standard violated 500, 505, 540, 705, Ind AS 109. Since auditor ignored impairment even with non-recoverable loans and then thereby violated Ind AS 109 as well. Why verification and provision is so critical? Because it prevents fund diversion, accurate financials, non-provisions, receivables affect the profits and net worth, and then stakeholder trust. Ignoring impairment and failing to provision for uncollectible amounts mislead banks and investors and stakeholders. Key takeaways for auditors. Auditor always has to test material advances and receivable for collectibility. Auditors have to perform aging analysis, external confirmation, review subsequent receipts. An SSC provision is required as per Ind AS 109, that is for credit loss provision. And modified opinion, if impairment is evident but not booked by the company, considered modifying the audit opinion under SA 705. Instead of purely relying on a management representation. Sorry. Now, misuse or omission of modified opinions. The standard of auditing 705. Here we are taking 705 and 706. Here, modified opinions, including qualified opinions, adverse opinions, or disclaimer opinions. When material misstatements are present in financial statement or when there is a insufficient appropriate audit evidence to form an opinion, then the opinion has to be qualified, adverse, or disclaimer. Auditor must carefully evaluate the nature and pervasiveness of the issue. And under 706, emphasis of matter, auditor to emphasize the matter that is already disclosed properly in a financial statement, which is not a misstatement, but one has to be very careful to know that EOM is not a substitute for a modified opinion, because in many of the cases, NAFRA has found that auditors took shelter of EOM, emphasis of matter, and not gone for an opinion to be modified. Now, three types of opinions which I discussed earlier, either it has to be qualified, either it has to be adverse, either it has to be disclaimer of opinion. What went wrong in NAFRA cases? In several NAFRA orders, auditors were found encountered material misstatement, did not qualify, despite that did not qualify or modify their opinion, and instead, as I mentioned, used emphasis of matter to mention issues and not qualify the report. Result, misleading clean report that give false assurance to users. Now, case studies of Reliance Capital, Sobha and Banpur Cement, which were discussed earlier, so I'll not repeat it for the paucity of time. Only in case of Banpur Cement, the auditor failed to report 15 crores of NPA interest, not recognized, against Ind AS 109. An auditor failed to report undisclosed tax demand of 17 crores rupees. And despite that, issued a clean opinion being clear material misstatement. Standard violated 705, 706, 7700. Here is also very extremely important slide. which narrates the difference between KM, emphasis of matter, and modified opinion. When all of differently, when a trigger takes place, when matters of most significant in the audit requiring significant audit judgment, then KM is applicable. Emphasis of matter appropriately presented, disclosed, but are fundamental to understanding financial statement. The EOM is to be considered. And if the material misstatements or inability to obtain audit evidence affecting financial statement, then audit has to take shelter of modified opinion. Use cases: complex accounting estimate, fair value, litigation, revenue recognitions are covered under KM. But if going concern uncertainty, major subsequent event disclosed, and contingent liability are to be covered under emphasis of matter, and material misstatement not corrected by the management, or it has to be under either qualified adverse or its disclaimer of opinion. Now, auditor responsibility: identify, assess, and communicate KM in auditor's report. In case of emphasis of matter, highlight a disclosure already made in financial statements. And in case of modified opinion, auditor has to express a modified opinion, explain the basis very clearly, why it is qualified opinion. Now, requirement in all audits: KM, yes, for all listed companies and certain large unlisted entities. For EOM, not mandatory, applied based on auditor's judgment. And for modified opinion, arises when audit opinion must be qualified, adverse, or disclaimed. Why misuse of emphasis of matter is serious issue? Because users comprises of investors, lenders, regulators, etc. rely heavily on a modified opinion to understand financial risk. Using EOM, emphasis of matter, or skipping modification hides this risk. So, not mentioning as a qualified opinion but taking shelter of EOM is a risk to the users. Professional misconduct: NAFRA considered this as a gross failure in reporting responsibility and professional misconduct, resulting in penalty and damage to the professional reputations. How to use EOM and modified opinions correctly by the auditors. Assess materiality. Auditor has to determine if the issue is misstatement or just a disclosed uncertainty, and evaluate the potential impact on the financial statement. Modify opinion when needed. Use qualified or adverse opinion for misstatement, but not under EOM. Only use EOM when issue is already adequately disclosed and financials are not misstatement, however critical for users to understand it. In that case, auditor has to cover it under EOM. A qualified opinion is appropriate when the misstatement is material but not pervasive, while an adverse opinion is required when the misstatement is both material and pervasive, that is extensive all over. Document rationale is very important, maintaining the documentation. Clearly explain the reason for the opinion type in audit documentation, include detailed analysis of the issue, evidence considered, and reasoning behind the auditor's conclusion. Whether you go for a EOM or whether you go for a qualified opinion, you need to maintain the documentation, clearly having the proof of detailed analysis, evidence collected, and the reasoning. Key takeaways under SS 705: misuse of EOM. As I mentioned, there is nothing. If the auditor use EOM but not going for a qualification, as per NAFRA, this is nothing but deception. Clearly document the reason for opinion, as I mentioned. And SS 705 strictly mentioned, when in doubt, lean toward transparency. Now, a guiding principle also, I read somewhere in the order, if the user of financial statement would change that decision, if they knew the issue, then auditor should go for a modification of the opinion. Now, non-compliance of key standards on auditing. This is the 8th lapses found Now, non-compliance of key essays is nothing but a failure to follow the backbone of audit practice. Now, essays are mandatory framework to ensure risk-based audit planning, reliable audit evidence collection, appropriate audit judgments, and transparent communication of findings. NAFRA found that there are a number of cases where repeated violation of under SA 500, 505, 315, 330, 260, 265, and 540 showing systemic failure in audit execution. Now, all these indicate lack of due diligence and professional skepticism, which leads to material misstatement going undetected, which raise concern about the quality and reliability of audit opinions. Non-compliance implies the audit was not done properly, even if a report is issued. These are the observations on NAFRA. If standards of auditings are not looked into by the auditors, so there are non-compliance of standard of auditing, even though audit is complete, NAFRA has considered in some of the cases that audit report is incomplete. Major standard repeatedly violated. SA 500 under audit evidence and external confirmation, 315 material misstatement, an auditor response to the audit risk, SA 260 that is communication with those charged with the government's governance, that is board of directors and audit committee, and under 265 communicating internal control deficiency to again board of directors or the audit committee. Under 540, auditing accounting estimate, recoverability, impairment, and valuation, which we discussed in earlier slide. Consequences of violation of key standard of auditing. It amounts to professional negligence and misconduct under clause 7.8, part 1 of the second schedule of CA Act 1949. In many cases, NAFRA concluded that the audit was not performed at all, despite a signed report. This is very important to note. Stakeholder arm, investor, lenders, and regulator are misled by unreliable audits. Why these standards are so important? Because 500, 505, as per the violation, it amounts to audit becomes guesswork without evidence. Under 315, 330, audit may miss fraud or major misstatement. And under 540, it amounts to overstated assets or fake values remain unchecked as a matter of violation. Key takeaways: compliance with standard of auditing, plan-based risk, audit procedure must be tailored to each client risk profile. And as per documentation, test and record all assumptions, especially for high value items. Engage with governance, as I mentioned, communicate significant issues, those charged with the government, that is board of directors and audit committee, and obtain and retain external confirmation, verbal or internal. Failing to follow this basic standard amount to audit failure, even if report is issued as per NAFRA observation. Related party transactions, everybody knows, but for the sake of repetition, I'll take some of the important things. Auditors under 550 require to identify RP and relationship, understand nature and purpose of RPT, evaluate and verify, that is particularly arm's length pricing, ensure proper disclosure is there in financial statement, because treat RPT as a high risk area since they are often used to shift profit or losses, divert funds, and create fictitious transactions. NAFRA has observed, as far as the reporting on RPTs by auditors, that auditors fail to identify RPs or report their relationship. Auditor did not test if transactions were on an arm's length basis. Auditors ignored lack of approval from board of directors or shareholders, AGM or EGM, and this auditor did not ensure disclosure under Ind AS 24 and Ind AS 18. These are overlooked signs of round tripping and circular transaction to group entities. Case study, Coffee Day, Lexus Granito, Man Industries, we have discussed earlier. Standard violated 550, 500, 265, ES 24, ES 18, Schedule 3. Schedule 3, in one of the cases, the company has net off the advances and payables. I mean, that is against the Schedule 3. Key takeaways, treat all related party transactions as significant risk and test them thoroughly. Never assume management disclosure as complete. Ensure contract. Auditor has to go through each and every contract with related party which and verify the pricing logic and approvals, whether proper approvals are in place from either the board or the shareholders. And without fail to ensure that the transaction have taken place at the arm's length. And report about the abnormality of risk to the governance to those charged with the governments. Now, the last audit lapse which was observed, SQC1 and EQCR, quality control breakdown. When quality control system fails within the audit firm, the audit fails before it happens. These are the observations. Under SQC1, standard on quality for firms, it applies to all firms performing audits and mandates that firm. Now, what happens? It applies to all firms to establish a system of quality control to ensure within the firm all audits are conducted as per the standard of auditing and a professional standard with ethics and independence. Audit reports are appropriately reviewed and monitoring documentation of the firm by the quality control reviewer partner. Now, EQCR, Engagement Quality Control Review. It is mandatory review for high-risk audit, especially for listed company, public interest entities, and complex engagement. EQCR to be conducted by a senior and experienced audit partner not involved in the audit, who will review significant audit judgments by the audit team, assess whether audit report is appropriate, and ensure compliance with standards and regulations. These are the duty of EQCR partner. What went wrong in NAFRA cases as per EQCR and SQC1? Firms did not perform EQCR. False representation, falsely named EQCR reviewer, who later denied involvement. Lack of documentation, internal deficiency. There were no peer review mechanism to catch audit failures before reports were issued. These findings indicate serious lapses in audit control. Case studies, NAFRA orders. As we mentioned, in case of Banpur Cement, EQCR was falsely claimed to have been performed. In fact, it was not performed. The person who named as a EQCR reviewer later denied any such role. And there was no documentation to show any quality review ever took place. In case of Lexus Granito, no EQCR was done despite a listed company. Audit file had no review notes, no reviewer sign-offs, and no evidence of engagement monitoring. NAFRA concluded that the firm lacked basic SQC1 compliance. Now, regulatory violence under SQC1, which requires the firms maintain firm-wide quality control system. But under the violation, they found that there were no policy, no evidence of reviews, or no monitoring. EQCR mentioned under SQC1 para 35 to 42, which requires mandatory review of listed or public interest audit. Under violation, it was observed that no EQCR was performed or documented. Code of ethics, no independent checks on audit teams by the EQCR reviewer. And SA 220, no partner review of key audit decisions were found. Key takeaways on SQC and EQCR from NAFRA inside. It is extremely, extremely important when a particular case is referred to NAFRA. The auditors, the partners, engagement partner, and EQCR reviewer is required to follow all this. EQCR is not optional, but it's mandatory for all listed companies. Without proper EQCR and SQC1 system, firms cannot ensure audit quality. Firm has to appoint independent qualified EQCR reviewer for listed high-risk audits. Firm has to maintain documentation of review notes. Firms must have working SQC1 policy in place. Peer review has to be in place. Partners have to avoid over-reliance on the management and legal opinions. Partners have to escalate red flags proactively and transparently. Very importantly, adopt forensic lens in auditing in an audit of related party transactions. As if you are doing the forensic audit of related party transaction, auditor has to absolutely take care about the minutest part. Last but not least, but never delay or backdate documentation, because NAFRA has found that in some of the cases, there were cases of file integrity. There were backdated documents were added. And I mean, so file integrity is non-negotiable. Now, this is my last slide. These are the current cases which are under investigation by the various regulatory authorities, that is SEBI, NAFRA, ICI, under the CO motto. And then over a period of time, we will be able to know the kind of potential violation under material misstatement, neglect of fraud risk, omission of modified opinions, related party transaction, EQCR and AQC violation. In case of IndusInd Bank, you know the potential regulatory violation require investigation. The investigation is going on. Gensol Engineering Limited, subject to compliance review of possible violations, the investigation is on. Technology platform company Verse Innovation, which is the parent company of Daily Hunt, the news portal, which is under scanner for round tripping of with London-based startup company, now under bankruptcy, which is the name by Builder AI, which is an AI startup company based out of London. All Chinese mobile companies, including Oppo, Realme, Xiaomi, and Vivo, they are under regulatory scrutiny and will be able to find the potential violation when the final investigation is completed, and then the regulators, either SEBI or NAFRA or ICI, will come out with their decision. Will be able to know what kind of violation, which we earlier discussed about all these 10, how they were included under the investigation. This is my personal view. While NAFRA primarily oversees statutory auditors, internal auditors can also be held accountable if their negligence contribute to financial irregularities which arise from failure to detect or report fraud due to non-compliance with standard of auditing or lack of professional skepticism, and NAFRA may initiate action under 132(4) of the Companies Act against internal auditor as well. This is my purely personal view, and I put a disclaimer for this. That's all. Thank you very much for patient hearing, and I'm very happy to share my views under the same. Thank you.
Thank you so much, sir. Now come to the question answer session. The first question coming up is this. NAFRA points out certain deficiency in audited accounts and reports. What actions are to be taken with respect to audited accounts?
See, madam, in my presentation, I already mentioned about the various lapses found by NAFRA and from the auditor side, and what kind of precautions to be taken that these kind of lapses are not to take place. Okay. So already part of my presentation.
Yeah. Thank you so much, sir. Now, the next question is, what action has NAFRA taken, if any, where the audit quality is not up to the mark? I think this first and second is almost the same question.
Madam, audit quality, I mentioned all 10 irregularities or lapses.
Yeah. So now the second, another one is whether audit files to be maintained can be in soft format or whether physical files are also to be maintained with original invoices, vouchers, and reports.
There is no question of maintaining vouchers and invoices in a physical form, and then it will be always okay if you maintain this in a soft format, but then it has to be authenticated,
Okay.
and then it should prove that it were taken and saved and preserved at the time of auditing, not at a later date.
Okay. So this is all about the session and the question answers. Now, with this, we come to an end of today's webinar. We hope all the participants have gained much more valuable knowledge on the topics discussed in both the sessions. Now, it is requested to all the participants to stay connected for more learning opportunities. Thanks to our speakers for sharing their expertise, and always be thankful for our participants as well. Thank you so much. We'll meet again on Fridays. So stay tuned for the Friday session. Thank you so much.
Thank you, madam. Thank you.
I would like to thank both the faculties and ma'am.
Thank you so much.
Thank you.
Thank you.
Yeah.
Bye-bye.
Bye.
Have a great day.
Same here, sir.
Sure, we can.
Yeah.